To begin, welcome to our deep dive on how an early head start in investing can radically change your retirement outlook. In this video, we will explore how compounding works, why prudent return assumptions matter, and which strategies accelerate financial independence. We will also walk through practical steps, simple examples, and visual frameworks to help you make confident decisions. Finally, we will wrap up with key takeaways, a couple of quizzes, and a clear call to action. Next, here is our roadmap. First, we cover why a head start matters. Then, we compare realistic return assumptions with more aggressive forecasts. After that, we translate nest egg size into retirement income using the 4% rule. From there, we move into optimization, tax-advantaged accounts, and housing decisions. We will reinforce concepts with visual diagrams and 2 short quizzes. Finally, we will end with key takeaways and practical next steps. Now, let us lay the foundation. If you have accumulated around $200,000 by age 30, the most powerful driver of your retirement outcomes, compounding, is already on your side. As time passes, returns generate returns, creating exponential growth. Even if you never contributed another dollar, that early base can expand significantly by traditional retirement age. In turn, this positions you to convert your wealth into steady retirement income using a sustainable withdrawal strategy. Continuing on, compounding magnifies an early nest egg. Over about 35 years, $200,000 can grow more than 10 times at 7%, or more than 28 times at 10%. While higher returns are enticing, planning for a lower, more conservative real return provides durability against inflation and volatility. Additionally, remember that actual outcomes depend on market behavior, your fees, and your chosen asset allocation, including the role of bonds that may temper growth compared with pure equity exposure. Moving forward, this table summarizes approximate end values for $200,000 invested from age 30 to 65 under different return assumptions. A 5% real return indicates inflation-adjusted purchasing power of roughly $1.1 million. A 7% nominal assumption suggests a result just above $2 million. An 8% nominal scenario approaches $3 million. Finally, a 10% nominal path can exceed $5.5 million, though it is aggressive and should not be the baseline for prudent planning. Question time. If $200,000 is invested from age 30 to 65 at a 7% average annual return, which is the closest outcome? Option A, approximately $1.1 million. Option B, approximately $2.1 to $2.2 million. Option C, approximately $3.5 million. Option D, approximately $5.6 million. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is option B, approximately $2.1 to $2.2 million. Over roughly 35 years, 7% growth compounds to about 10.7 times the original amount, leading $200,000 to end near that range. Next, let us translate a portfolio into income using a conservative 4% withdrawal rate. For instance, if your nest egg is around $2.25 million, 4% produces approximately $90,000 per year before taxes. This baseline does not include Social Security, which may further supplement your retirement income. During market downturns, moderating withdrawals or temporarily reducing discretionary spending can significantly improve the durability of your plan. Meanwhile, it is important to compare aggressive assumptions with more prudent ones. On the left, a 10% return may appear in historical equity benchmarks, but remains volatile and uncertain, especially once you include bonds or face drawdowns. Relying on 10% can lead to undersaving if actual returns fall short. On the right, planning at 7% provides a balanced approach that aligns with diversified portfolios and reduces the likelihood of a funding gap in retirement. Continuing the journey, this mind map places financial independence at the center. The tax-advantaged accounts branch emphasizes prioritizing the employer match in the 401k, then using Roth individual retirement accounts or a backdoor Roth for high earners, leveraging the health savings account for triple tax advantages, and using a brokerage account for additional investing. The debt and expenses branch stresses eliminating high-interest debts, optimizing insurance coverage, and reducing recurring bills to increase saving capacity. The housing strategy branch highlights the power of owning a home outright, choosing a low cost of living area, and exploring house hacking to reduce or offset housing expenses. The risk management branch covers maintaining an emergency fund, choosing an appropriate asset allocation, rebalancing periodically, and minimizing fees. Finally, the income flexibility branch suggests side income, career pivots, or part-time work to support withdrawals in difficult markets, thereby improving long-term resilience. Building on that, here are concrete steps to execute. First, grab your employer match in the traditional 401k. Second, if eligible, contribute to a health savings account and invest the balance for long-term growth. Third, use a Roth individual retirement account, or apply a backdoor Roth if your income exceeds eligibility thresholds. Fourth, gradually increase 401k deferrals toward the annual limit as your budget allows. Fifth, eliminate high-interest debt and consider refinancing if it reduces total costs. Sixth, automate contributions and set an annual rebalancing routine. Seventh, select low-cost, diversified index funds rather than expensive, complex products. Eighth, maintain a 6 to 12-month emergency fund to absorb shocks without selling investments at a loss. Furthermore, reducing housing costs is one of the highest impact moves you can make. Owning your home outright can drop your required financial independence number substantially by lowering your baseline living expenses. Relocating to a low cost of living region amplifies that effect. If appropriate, house hacking by renting a room or an accessory dwelling unit can offset remaining costs. Finally, compare the mortgage rate with your expected investment returns to decide whether prepayments make sense within your overall plan. Next up, this timeline shows key checkpoints from age 30 to 65. At 30, you begin with a seed capital of roughly $200,000. By 35, the focus is on staying the course and automating contributions. At 45, you assess your asset allocation and verify fee discipline while rebalancing. At 55, you stress test sequence of returns, risk, and rehearse retirement income needs. Between 62 and 67, you evaluate Social Security claiming strategies. Finally, at 65, you handle Medicare enrollment and begin retirement in earnest. Additionally, this pie chart highlights a sample retirement budget allocation. Housing, even if reduced, still consumes a sizable share. Healthcare costs and insurance remain significant and require planning. Essentials like food and transportation follow. Leisure and travel represent lifestyle choices that can be adjusted during lean market years. Utilities and taxes round out the picture. Adjusting these categories provides flexibility to preserve portfolio longevity. Here's another quick question. Which account is often called triple tax advantaged and is particularly powerful for healthcare costs in retirement? Option A, traditional 401k. Option B, Roth individual retirement account. Option C, health savings account. Option D, taxable brokerage. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is option C, the health savings account. The HSA offers pre-tax contributions, tax-free growth, and tax-free withdrawals when used for qualified medical expenses, making it a uniquely powerful tool for retirement healthcare planning. As we consolidate, the main ideas are clear. First, starting early allows compounding to drive results. Second, plan using a 7% average return and stress test with 5% real to protect against inflation and volatility. Third, convert assets to income with a prudent withdrawal rate while remaining flexible. Fourth, prioritize tax-advantaged accounts including the 401k, Roth IRA, and HSA. Fifth, lower housing costs to reduce the portfolio size required for independence. Finally, control fees, rebalance periodically, and keep a robust emergency fund. Before we close, a brief disclaimer. This content is for educational purposes only and does not constitute individualized financial, legal, or tax advice. Past performance does not guarantee future results. You should consult a fiduciary financial advisor or tax professional for guidance specific to your situation and verify current rules, contribution limits, and eligibility criteria. To conclude, your early capital is a powerful engine that can deliver remarkable results when paired with realistic expectations. Use the 4% rule to estimate sustainable income, but remain flexible. maximize tax-advantaged accounts, and reduce housing costs to accelerate progress. Finally, stress test plans with a 5% real return and maintain a disciplined rebalancing process to manage risk. And finally, if you found this helpful, please like the video, share it with someone planning their future, and subscribe for more evidence-based financial content. In the comments, tell us your financial independence milestone, the return assumption you plan with, and one optimization you will implement this year.